Welcome to part 2 of this Tesla analysis. In part 1, I had alluded to the issues I have with market commentators, analysts, investment managers, and social media pundits giving too much credit to Robinhood traders for Tesla's meteoric share price rise. Just to highlight a few things on the chart, I have two Elliott wave labels, which I have labeled 1 and wave 2. I won't get into detail as to why I've labeled them wave 1 and wave 2, as I will cover this in detail in part 3 of this analysis when I do the Elliott wave appraisal. When I hover over a node, like here for example, there's two key pieces of information that we will be paying attention to here. The first one, represented by percentages, is the percentage of free float shorted by hedge funds. In this case, 19.7%, and the dollar value is the dollar volume of shorts, which in this case was 10.3 billion. And just to highlight something very interesting, at the peak of wave 1 at 77.49, which is the post-share split adjusted prices. On this particular day, which is the 7th of August 2018, Elon Musk had sent a letter to employees and published it on Tesla's blog, claiming that Tesla is the most shorted stock in US stock market history, citing this as motivation to go private, as short sellers, which are hedge funds in this case, are attacking Tesla. As we saw in part 1 of the analysis, he certainly had a point. Hedge funds had been short Tesla for a very, very long time. So if we look at the share price from the 77.49 peak to the bottom at 35.40, Tesla had gone through a 10-month cyclical bear market. And I say cyclical because the bear market itself lasted only 10 months, which is less than a year. And if we look at the price change during this period, the shares lost just over 54% in value. What is of most interest to me, though, is analyzing hedge fund activities during this bear market. So if we look at where we were in terms of hedge fund activities just prior to the peak in 2018, July, the percentage of free float shorted was 20.5%, which is extremely high. In the subsequent months, we started to see a slight decrease in this percentage of free float, but it was still in the 19 regions. And when the market started recovering again to almost testing the previous peak, we saw a slight decrease in shorting. So there was very little short covering which took place. As the market started to go down again, we can see that the float was just above 14%, but as the market started to accelerate to the downside, hedge funds started increasing their positions again. As we see here in February of 2019, the percentage of free float shorted went back above 15, and from there on subsequently accelerated to just under 19, 22%, and peaked at 24.5% in May of 2019. This is where hedge funds lost a lot of money. As we can see, as the market was going down, hedge funds increased their positions, but they increased their positions to such an extent that the peak short interest shorted was right at the market bottom. From this low at 35.40, we see that Tesla started to rally and then made a pullback to $42.20. And even during this period, the short interest was still high at 23% in June 2019 and 22% in July 2019. Around late August 2019, the market started to rally again, and the short interest was still high at 22% in August and 20% in September. What we then saw was more rapid acceleration in price, and here in October 2019, hedge funds started covering their short positions, and we can see here the percentage of float shorted was 17. And as price continued to rally, hedge funds had no choice but to cover more positions. If we look here in December 2019, the percentage of float shorted had dropped to 15.5%. And by the time we got to January of 2020, it was down to 12.57%. So we can see during this rally that hedge funds were covering their shorts, and the share price went on to peak at $193.80 on the 4th of February 2020. Now, at this juncture, I want to highlight a few things. At this peak of 193.80, this was pre-coronavirus crash, this was pre-US lockdown, this was pre-influx of Robinhood traders. It's evident that Tesla was already in a new bull market. And we can see this as Tesla not only made new highs, but from the low of at 35.40, the market had rallied over 440%. So Tesla was already in a new bull market. What I can deduce from this is before the lockdown, before the coronavirus pandemic had a significant impact on the market, amongst other market moving events, normal trading, hedge funds taking or covering their shorts had a significant impact on the share price. Now, when we look at what happened from 19 February 2020 to 18 March, this is where the coronavirus market crash occurred. But as I mentioned earlier, Tesla was already in a new bull market. So the coronavirus crash only accelerated the next pullback or correction within the bull trend, which was already intact. So if we look at the market bottom at $70.10 on the 18th of March 2020, this was just before the US lockdown. Now, from there on, without a doubt, the impact that Robinhood traders had on the market cannot be understated, because what we saw during this period was even more rapid acceleration in prices as more and more investors started speculating on Tesla. So if we look at hedge funds during the lockdown period, we can see that the percentage of free float shorted had dropped significantly to 10% in March of 2020, and in the subsequent months continued to drop, and by April we were down to 8.6. By June we were down 7.5, July down to 6.4, and in the subsequent months you can see that the percentage of float had dropped significantly below 6%, 5%, to where we are currently, or the latest data that I got, which was on the 11th of or 30th of November 2020. The percentage of free float had dropped to 4.91%. Now, as a believer in behavioral finance and the notion, or the original notion, that markets are irrational, Robinhood traders have certainly added to that irrationality, and it's really up to analysts, investors, and anyone who has a deep interest in the market to add this irrationality into their models. Fortunately for us as politicians, this irrationality is already captured by the Elliott wave principle. So in conclusion, one cannot overlook the impact that hedge fund activities have had on Tesla's share price. We saw percentage of free float shorted dropped significantly from above 20 to just below 5%. And that short covering also added to the share price acceleration. I hope you've learned something in this video, and I will see you in part 3 when I do the Elliott wave appraisal of Tesla to give us direction and clues as to where the share price is headed next. Thank you.